Welcome to the Deep Dive. We're here to cut through the noise and really zero in on the key insights from the latest data.
And today we're diving deep into Marathon Petroleum Corporation, MPC, a real giant in the energy sector.
We've got their Q2 2025 results plus their latest SEC filing. It's quite the treasure trove, really. Lots on financial health, strategy.
And what's coming down the pike, absolutely.
So our mission today for you is to get past just the number. We want to unpack the story here. How does a company this big handle such a dynamic energy world?
Right, from refining crude oil all the way to these big bets on renewables and pipelines. It's complex.
Exactly. Let's try and understand the why behind the what in these reports. Ready?
Let's do it. So, starting with the big picture, maybe, their Q2 2025 overall performance.
Okay. So headline numbers, net income, $1.2 billion. That's $3.96 per share.
And adjusted EBITDA landed at $3.3 billion for the quarter.
Now, if you put that side by side with last year, Q2 2024.
There's a difference, yeah. Net income was higher then, $1.5 billion, and adjusted EBITDA was just a touch higher at $3.4 billion.
So a bit of a dip year over year. It tells you something about the market conditions right now.
It really does. And if you zoom out to the first half of the year, that trend gets clearer.
How so?
Well, for the first 6 months of 2025, net income was $1.14 billion. Compare that to $2.45 billion in the first half of 24. That's a significant drop.
Wow, okay. And adjusted EBITDA.
Similar story. $5.68 billion for the first half of this year, down from $7.1 billion last year. So it's not just a blip, like you said. It's showing how even the majors feel these market swings.
But interestingly, the CEO, Marianne Mannon, she kind of framed these results differently.
How did she put it?
She said they reflect actions we have taken to deliver on our strategic commitments. And she seemed optimistic about the, quote, long-term outlook for refining.
So navigating the short-term bumps while keeping eyes on the long game. Makes sense.
Yeah. So what does that long game look like when you dig into their main business? Refining and marketing, or R&M?
Okay, let's peel back the layers there. R&M adjusted EBITDA for Q2 25 was $1.9 billion.
Which is only slightly down from $2.0 billion last year, right?
Exactly. But here's the interesting part. Sales revenue in R&M actually dropped by, get this, $4.37 billion.
Whoa. How does that square with the EBITDA being almost flat? Did volumes collapse?
Actually, no. That's the surprising thing. Their sales volumes were up by 129,000 barrels per day.
So they sold more fuel.
Yep. The revenue drop was almost entirely due to lower prices. Average refined product sales prices fell by 33 cents a gallon.
Ah, okay. So lower prices hit the top line hard, even with higher volumes. Classic commodity market stuff.
Precisely. And their actual refinery operations.
Yeah.
Pretty steady. Net throughput was stable at 3.06 million barrels per day. Crude utilization, very high at 97%.
Okay, but this is where I find it fascinating. The R&M margin, you said revenue was down, market conditions were weaker.
Right. But their margin per barrel actually ticked up slightly. $17.58 in Q2 25 versus $17.53 in Q2 24.
How? How did they manage that when things like the crack spreads were lower?
Yeah, the main market indicators like that Mid-Continent WTI 3-2-1 crack spread were definitely weaker. $15.54 barrel versus $16.62 last year. And crude differentials narrowed too.
So market headwinds.
Definitely. They estimated those market factors had about a $500 million negative impact on the margin.
Okay, so if the market took away $500 million, how did they end up slightly ahead on margin?
This is where their internal operations shine. They reported a net positive effect, also around $500 million, offsetting that market hit.
And that came from?
Things like optimizing their crude slate, managing market structure effectively, navigating RIN prices.
RINs, the renewable identification numbers, always tricky.
Very. Plus better refinery yield and improved fuel margin from their direct dealer sales. It really shows how much operational control matters.
It absolutely does. But what about costs? Did those go up?
They did. Refining operating costs rose to $5.34 per barrel from $4.91 last year. Mainly higher energy costs.
Okay. And turnarounds. Maintenance.
Planned turnaround costs were also up. $250 million total in the quarter, about $68 million more than last year, just due to scope and timing.
And the cost of those RNNs?
$314 million in Q2, up a bit from $293 million last year. And that's factored into the R&M margin figure we talked about.
Got it. So adapting constantly, but also investing. They've got some big R&M capital projects lined up for 2025, right?
Yeah, quite significant ones. $100 million going into the Los Angeles refinery. Improving competitiveness, utilities, reliability, efficiency, dealing with emissions regs. They expect a 20% return there.
And Robinson.
Robinson Refinery is getting $150 million this year, plus another $50 million next year. That's all about flexibility to produce more jet fuel. They're targeting a 25% return on that.
Jet fuel demand seems strong, and Galveston Bay, that sounds like a huge one.
It is.
Yeah.
$200 million this year, but another $575 million coming in 26 and 27. They're upgrading high-sulfur distillate to ultra-low sulfur diesel with a new hydrotreater. Big project, expected return over 20%.
So investing heavily in efficiency, cleaner fuels, high-demand products makes sense. And they also trim the portfolio a bit.
They did. Sold off about half their interest in an ethanol JV, got $425 million for it in July, and they expect a nice gain, maybe $245 million in Q3, streamlining things.
Okay, let's pivot now. Midstream. This is mainly their MPLX subsidiary, right? How's that side doing?
Really solid. Midstream adjusted EBITDA was $1.6 billion in Q2, pretty much flat with last year.
But year-to-date looks better.
Yeah, year-to-date it's up $3.36 billion in the first half of 25 compared to $3.21 billion last year. That growth comes from higher rates and more volume moving through the pipes and terminals, plus contributions from acquisitions they made.
And the scale there is just immense. What were those throughput numbers again?
For Q2, pipeline throughput was over 6.2 million barrels per day. Terminal throughput, nearly 3.2 million barrels per day. And natural gas processed, almost 9.75 billion cubic feet per day.
Just staggering. It really underlines how vital that infrastructure is. And they're growing it aggressively.
Very aggressively. Big acquisition announced, Northwind Delaware Holdings. That's $2.375 billion in cash.
What does that bring them?
Expands their sour gas capabilities, gathering, treating, processing in a key area of New Mexico. They're building out capacity there, aiming for 440 million cubic feet per day by late 2026, and it's backed by volume commitments.
So locking in future business, and they just took full control of another big pipeline, Bay NGL.
It closed July 1st, bought the remaining 55% for about $700 million, plus a potential earnout. Now they own 100%.
And that pipeline is expanding, too.
It is, going from 250 up to 300,000 barrels per day expected in the second half of 2026. That deal also let them wipe out over $650 million in related debt.
And they expect a gain from that transaction as well.
Yeah, they mentioned an estimated gain over $400 million coming in Q3 from that.
Plus, they bought Whiptail Midstream earlier in the year.
Correct, back in March. Added gathering systems in the San Juan Basin for about $237 million. It's clear they're systematically building out their midstream muscle, especially in places like the Permian and San Juan.
And looking ahead, even more projects. Processing plants like Secretariat in the Permian, Harmon Creek III in the Northeast.
Right, adding significant processing capacity. Secretariat adds 200 million cubic feet per day. Harmon Creek III adds 300 million. These are big capacity jumps.
And more pipelines. Blackcomb, Rio Bravo, moving Permian gas to the Gulf Coast.
Exactly. Billions of cubic feet per day in new transport capacity plan there. Plus, the Traverse pipeline along the Gulf Coast, that's bidirectional, enhancing market access. Expected 2027.
They're even moving further downstream in midstream with fractionation plants and an LPG export terminal.
That's right. 2 big fractionators near Galveston Bay coming online in 28 and 29, and a partnership with ONEOK for a large LPG export terminal also aiming for 2028.
It's a massive long-term infrastructure build-out. Clearly a bet on continued strong demand for natural gas and NGLs, especially for export.
No question. And financially, MPLX looks strong. $1.4 billion in cash at the end of June, plus room on their buyback program.
And MPLX sends cash back up to the parent company, MPC.
Oh, yeah. MPSC got $1.24 billion in distributions from MPLX just in the first half of this year. And MPLX just got another $1 billion approved for unit repurchases. It's a cash engine.
Okay, let's switch gears again. Renewable diesel. How's that segment looking? Still finding its footing.
It is. Still reported negative adjusted EBITDA in Q2, minus $19 million. Yeah. But that's actually an improvement.
Better than last year.
Yep. Q2 last year was negative $27 million, and year-to-date, it's gone from negative $117 million in the first half of 24 to negative $61 million this year. So, still in the red, but moving the right way.
What's driving that improvement?
Well, the renewable diesel margin itself increased from $37 million last year to $49 million this Q2. That came from running the plant harder, higher utilization, and better margins per gallon, plus more valuable environmental credits because they produce more volume.
Ah, so volumes were up significantly.
They really were. Sales volume jumped to over 1.3 million gallons per day from about 1.1 million last year. And actual production volume rose quite a bit too, over 1.1 million gallons per day versus 905,000.
And wasn't there an issue last year at their Martinez facility that impacted things?
That's right. An event in 2023 held back throughput and margins in early 24. So these latest numbers show a good recovery and operational improvement. It definitely shows they're serious about this space, even if it's not profitable yet.
Okay. So pulling it all together, what's the overall financial health picture? Liquidity, debt?
Looks pretty solid.
Hmm.
As of June 30th, MPC had $1.7 billion in cash overall, with $1.4 billion of that sitting at MPLX. Importantly, they had nothing drawn on their main $5 billion credit line.
So plenty of available cash and credit.
Overall liquidity for MPC itself is over $5 billion. MPLX had nearly $5 billion in liquidity, too. Very robust.
And how are they managing their debt load? Any big moves there?
They're actively managing it.
Yeah.
They paid off $1.25 billion in notes that came due in May. Earlier in the year, they issued $2 billion in new notes, basically refinancing maturing debt.
And MPLX?
Similar activity. MPLX paid off $500 million in notes in February, then issued $2 billion in new longer-term notes in March, partly to pay off another $1.2 billion that was coming due in June. So proactive debt management.
And returning cash to shareholders, still a priority.
Seems to be. MPC returned about $1 billion in Q2, mostly through share buybacks, almost $700 million worth.
And they still have authorization for more buyback?
A lot more. $6 billion still available under the MPC authorization as of June 30th.
Wow. And MPLX is buying back units too?
Yep. Bought back $100 million worth in Q2. Had $320 million left on their authorization then. And as we said, just got another billion approved in August.
So, the whole financial picture, strong liquidity, active debt management, significant returns to shareholders, it paints a picture of, well, financial strength and confidence, wouldn't you say?
I think that's fair. Even with the year-over-year dip in earnings driven by market conditions, the underlying financial structure looks quite sound.
Okay, so looking ahead just a bit, what's their guidance for Q3?
They give some specific numbers. Refining operating costs expected around $5.70 per barrel. Planned turnaround costs are projected to be higher in Q3, around $400 million. And they expect crude throughput around 2.73 million barrels per day.
Gives a sense of the near-term operational rhythm and longer-term industry-wise.
They sound pretty positive, actually. They use the term constructive on the long-term outlook for refining. They think global demand growth will probably outpace new refining capacity additions for the rest of the decade.
Interesting view. And for Midstream.
They feel it's well-positioned, especially to support growing natural gas demand, including LNG exports. So aligning with those big infrastructure investments we talked about.
No discussion of a major energy company is complete without touching on the legal and regulatory side. That's always part of the landscape, right?
Absolutely. And they disclose several things. There are those ongoing climate-related lawsuits in a number of states: California, Delaware, Maryland, Hawaii, South Carolina, Oregon.
What's the gist of those?
Generally, they allege the company misrepresented the impacts of petroleum products. They seek damages, but the amounts aren't specified. It's important to note these are ongoing lawsuits. The outcomes aren't determined.
And there's that issue with the Tesoro High Plains pipeline.
Right. That's a complex one involving the Bureau of Indian Affairs, claims of trespass, a demand for $187 million, and a resulting lawsuit MPC filed against the government. A section of that pipeline is still shut down, and they're waiting on an environmental impact statement next year.
Shows how complex just operating infrastructure can be. Any other new items?
There's a recent enforcement action from the Washington Department of Ecology, started just August 4th, alleging hazardous waste violations, seeking over $1 million in penalties. Again, part of the operating reality for a company this size.
And regulations change, too. That new One Big Beautiful Bill Act.
Yes, enacted July 4th. It's got tax implications, permanent extension of some provisions, 100% bonus depreciation for new property. They're still figuring out the full impact, but it will affect their financials.
So understanding all these external factors, market views, legal challenges, regulatory shifts, it's crucial for getting the full picture.
Definitely. It's a complex environment they navigate.
So wrapping things up, we've journeyed through Marathon Petroleum's latest results, their big strategic moves in refining midstream renewables.
And touched on the external pressures like regulations and legal issues. You really see how it all connects, don't you? The price of sour crude affecting margins, which influences investment decisions, leading to multi-billion-dollar pipeline deals. It's all intertwined.
It really is. What stands out to me is that balancing act. Managing the core refining business day to day while simultaneously making these huge multi-year bets on midstream infrastructure.
Yeah, they're clearly playing the long game on energy demand, investing heavily in transport and processing, even while they carefully nurture that renewable diesel segment.
Which leads to maybe a final thought for you or listener to chew on.
Given these massive long-term infrastructure commitments, essentially big bets on how we'll use energy for decades, alongside the performance of their traditional refining business, what does this tell us about where major energy companies are heading?
Right. How do they manage to, protect their existing strengths while also adapting strategically to a world that's increasingly focused on new energy forms and environmental concerns? It's a fascinating question.